History doesn't repeat itself, but it rhymes. It whispers the same warnings, sings the same siren song of effortless wealth. We see the same headlines, a century apart. We feel the same fever. We tell ourselves the same lie. This time, it's different. A quick montage cuts between black and white footage of 1920s flappers dancing and modern clips of crypto enthusiasts at a conference. We see a grainy shot of a ticker tape machine spewing paper, then a split-second shot of a crashing stock market graph on a smartphone. The sound is a frantic jazz tune that slowly morphs into a modern electronic beat, then cuts to silence. A single, chilling voiceover begins. It's not a question of if the wave will crash. It's only a question of when. And what if the calendar already has a date circled in red? October 1929, September 2008. Two dates etched into history. Two moments when the world woke up to find the floor had vanished. They feel like isolated disasters, economic earthquakes, unpredictable acts of God. But what if they aren't? What if they are just 2 points on a much larger hidden blueprint? A pattern of human behavior so predictable, so reliable, it functions like a law of nature, a cycle of boom and bust, of euphoria and despair that repeats roughly every 100 years. We've dissected the wreckage of the past. We've written libraries of reports on what went wrong. But have we missed the most important question? Is there a map? A sequence of events? A financial DNA that connects every major crash? And if there is, where on that map are we standing right now? To understand the crash, you must first understand the party. The year is 1925. The Great War is a fading scar. America is stepping onto the world stage, not as a soldier, but as a titan of industry. The air crackles with invention. Henry Ford's Model T isn't just a car. It's a promise of freedom delivered on an assembly line. The radio isn't a box of wires. It's a voice in every living room, knitting a nation together with jazz, news, and advertisements for things people suddenly couldn't live without. This wasn't just an economic boom. It was a psychological one. A collective decision to believe in tomorrow, more than ever before. And nothing embodied that belief more than the stock market. Before the 1920s, Wall Street was a private club for the wealthy, a place of arcane rituals and whispers behind closed doors. But now, the doors were kicked open. The invention of consumer credit changed everything. You could buy a car on an installment plan, a washing machine, a stock. The market was democratized, they said. It was every man's game. And the game was intoxicating. Stories filled the papers of telephone operators and shoeshine boys making fortunes overnight. A new financial tool became the talk of the town. Buying on margin. It was a magic trick. You only had to put down 10% of a stock's value. The broker loaned you the other 90. It was like putting a $10 bet on a horse, and if you won, getting paid as if you'd bet 100. As long as the stocks went up, everyone was a genius. And they only went up. Radio Corporation of America, RCA. In early 1928, it was trading at $85 a share. By the end of the year, it was over $400. It didn't make a profit. It had never paid a dividend. It didn't matter. The story was better than the balance sheet. The future was worth more than the present. This was the new gospel. Economists, the high priests of the era, gave their blessing. Irving Fisher, one of the most respected academics of his day, declared in 1929, stock prices have reached what looks like a permanently high plateau. It felt less like an economy and more like a national fever dream, a shared belief that the laws of financial gravity had been suspended, just for them. The warning signs were there, for anyone who cared to look. Agricultural prices had been falling for years. The industrial boom was creating a vast, dangerous gap between the rich and the poor. But no one wanted to hear it. The music was too loud. The party was too good. The ticker tape was a ribbon of pure hope, printing money out of thin air. and everyone, from the titans of industry to the clerk at the corner store, was dancing as fast as they could. Every bubble has a pin. The tension comes not from the pop, but from the slow, deliberate movement of the pin towards the stretched and thinning skin. In the late 1920s, the pin was debt. Margin debt was the rocket fuel of the boom, but it was also the bomb. By 1929, the total amount of money loaned to speculators was greater than the entire currency supply of the United States. It was a tower of promises built on a pinpoint of actual cash. A few quiet voices began to raise alarms. Paul Warburg, a respected banker, warned of an orgy of unrestrained speculation. He was dismissed as a pessimist, a man who didn't understand the new era. The Federal Reserve, the supposed adult in the room, saw the danger. They tried to gently tap the brakes, raising interest rates. But it was like trying to stop a freight train with a feather. The market just screamed higher. The smart money, the men who had built the party, began to quietly slip out the back door. Joseph Kennedy, patriarch of the political dynasty, famously decided to sell everything when he got a stock tip from his shoeshine boy. He reasoned that when everyone was an expert, the game was over. The summer of '29 was the peak of the delirium. The market churned, hitting an all-time high in early September. The air was thick with denial. A slight dip? A buying opportunity? A bigger drop? Just shaking out the weak hands. The system was flashing red, but everyone was staring at the green ticker. Now, fast forward 80 years. The names have changed, but the music is eerily familiar. The dot-com bubble burst in 2000, a harsh lesson in speculation. But memory is short. The Federal Reserve, trying to cushion the blow, slashed interest rates to historic lows. Money became cheap, dangerously cheap. Wall Street, ever creative, needed a new story to sell. They found it in the safest, most American of assets, the home. They created a new magic trick: subprime mortgages, loans given to people with poor credit, people who would have never qualified for a mortgage before. On its own, a risky bet. But the wizards of finance bundled thousands of these risky mortgages together into complex securities called collateralized debt obligations, or CDOs. The theory was that while a few people might default, thousands of them wouldn't, not all at once. They sliced these bundles into pieces or tranches and got the rating agencies, the supposed independent referees, to stamp the safest pieces with a AAA rating. The same rating as a U.S. historic government bond. It was financial alchemy, turning lead into gold. And the world couldn't buy enough of it. Pension funds, foreign governments, banks, everyone wanted a piece of the safe and high-yielding American housing market. Just like margin debt in the '20s, this created a feedback loop. The demand for CDOs created a demand for more mortgages to stuff into them, which meant lending standards were dropped to nothing. Ninja loans became common. No income, no job, or assets. If you could breathe, you could get a mortgage. And just like the '20s, the price of the underlying asset, in this case, houses, only went up. People were using their homes like ATMs, refinancing to pull out cash. Everyone believed in a new, permanently high plateau. The warnings were there again. A few hedge fund managers, like Michael Burry, read the fine print. They saw the impossibly high number of risky loans inside the AAA-rated securities. They started making massive bets against the housing market. They were called crazy. They were dismissed as Cassandras. In 2006, the housing market started to wobble. By 2007, cracks were appearing everywhere. But the official line from the Fed chairman Ben Bernanke himself was that the subprime problem was contained. The music was still playing. The dance floor was still packed. The system was leveraged to an unimaginable degree, a global house of cards built on a foundation of bad loans and bad faith, and the pin was moving closer. The end doesn't arrive like a thunderclap. It starts as a tremor, a flicker on the screen, a knot in the stomach. On Thursday, October 24th, 1929, the tremor hit Wall Street. The market opened with a wave of selling. There were no buyers. The ticker tape, the mechanical heartbeat of the market, couldn't keep up. It ran hours behind, printing a history of a disaster that was still unfolding. Panicked crowds gathered outside the New York Stock Exchange, their faces a mixture of confusion and terror. The giants of Wall Street tried to stop the bleeding. They pooled their money to buy up stocks, a show of confidence. It worked for a day. The market stabilized. The weekend offered a brief, false calm. President Hoover assured the nation that the fundamental business of the country is on a sound and prosperous basis. But come Monday, the selling returned, a relentless, crushing tide. Then came Tuesday, Black Tuesday, October 29th. The floor of the exchange was a scene from a nightmare, a sea of men in suits, shouting, screaming, their faces pale with ruin. 16 million shares were traded, a record that would stand for decades. Fortunes built over a generation were wiped out in an afternoon. It wasn't just numbers on a board. It was a factory owner in Ohio, suddenly unable to pay his workers. It was a farmer in Iowa, watching his life savings evaporate. It was the end of a dream. The party was over. Now, September 2008. The tremor had been building for a year. Bear Stearns had already collapsed, a sacrifice fed to the market. But Lehman Brothers was different. It was a 158-year-old institution, a pillar of Wall Street, too big to fail. That was the belief. Over a frantic weekend, the heads of every major bank were summoned to the New York Federal Reserve. The government, led by Treasury Secretary Hank Paulson, delivered a shocking ultimatum: find a private buyer for Lehman, or we're letting it go. No bailout. The market needed to learn a lesson. A deal was almost struck, but at the last minute, it fell apart. On Monday, September 15, 2008, Lehman Brothers declared bankruptcy, the largest in U.S. history. The effect was instantaneous. It was like pulling the keystone from an arch. The global financial system, stitched together by trillions of dollars in interconnected credit and derivatives, froze. The credit markets, the plumbing of the economy that allows businesses to pay their suppliers and employees, simply stopped working. The stock market went into freefall. The Dow Jones dropped nearly 800 points in a single day. We saw the images. Lehman employees carrying their lives in cardboard boxes, their faces blank with shock. The revelation wasn't that a bank failed. It was the horrifying discovery of what the system had become. It wasn't about lending and borrowing anymore. It was a casino. The chips were our homes, our jobs, our pensions. The crash of 1929 and the crisis of 2008 were not different events. They were the same event, wearing a different costume. The core components were identical. 1. Cheap, easy money from the central bank, creating a sea of liquidity looking for a return. 2. A new, complex financial innovation that no one fully understood. Margin loans in the 20s, mortgage-backed securities in the 2000s. 3. A breakdown in lending standards, pushing debt onto the most vulnerable. And 4. The most powerful ingredient, a mass psychological delusion, a collective belief that this time, finally, the old rules of risk and reward no longer applied. The crash wasn't the disaster. The crash was the inevitable correction. The disaster was the bubble that preceded it. The ashes of 2008 were still warm when the architects of the next bubble got to work. The solution to a crisis caused by too much debt and easy money was even more debt and even easier money. Central banks around the world, led by the U.S. Federal Reserve, dropped interest rates to zero, and then they went further. They began a radical, untested experiment called quantitative easing. QE. It sounds complex, but it's simple. They printed money, trillions of dollars, not physically, but electronically. They used it to buy bonds, pumping cash directly into the financial system. The goal was to encourage lending, to stimulate the economy. But the money didn't go into building factories or funding new businesses. It went into the stock market. It went into corporate buybacks. It went into asset prices. The stock market, which had been decimated, began an epic, decade-long climb. It became completely disconnected from the real economy on Main Street. This was the new bubble, the everything bubble. And just like in the 20s and the 2000s, it came with its own set of new, poorly understood toys. Cryptocurrencies, sold as a decentralized future, became a playground for rampant speculation. Meme stocks saw worthless companies surge in value, driven not by fundamentals, but by social media hype. SPACs, or blank check companies, raised billions with no actual business plan. It was the same psychology, supercharged by technology. Instead of a shoeshine boy giving a stock tip, you had a teenager on TikTok promoting a new coin. Instead of buying on margin through a broker, you had zero-commission trading apps offering complex derivatives to anyone with a smartphone. The language was the same. HODL. To the moon. Diamond hands. It was a new version of "this time it's different," now with added emojis. Then came the COVID-19 pandemic. The global economy shut down. In response, governments and central banks unleashed the single largest torrent of stimulus in human history. Trillions more were pumped into the system. It was rocket fuel poured onto an already raging fire. Asset prices went vertical. And now, we are living in the quiet after the storm. The stimulus has been turned off. Interest rates have risen at the fastest pace in history, making the mountain of debt we've created incredibly expensive. We are in the eerie calm, the summer of 1929, the summer of 2007. The period where the foundation has cracked, but the building is still standing. The warning signs are flashing red again. Corporate debt is at an all-time high. A shadowy, unregulated private credit market has exploded, lending billions to risky companies, mirroring the subprime market. Geopolitical instability is shaking the foundations of global trade. The pattern is not just rhyming, it is screaming at us. The same ingredients are all on the table. A decade of artificially cheap money. Unprecedented levels of debt, both public and private. New speculative assets fueled by a narrative of a technological revolution. And a widespread belief among a new generation of investors that the market only goes up. The timeline between the end of one easing cycle and the beginning of the next crisis has been remarkably consistent. The stage is set. The actors are in place. The only question is what strikes the match. And the calendar seems to be pointing towards a date. 1929, 2008. The gap is about 79 years, but the cycles are accelerating. The dot-com bust was 2000. The Great Financial Crisis was 2008. The COVID crash was 2020. What if the next one is just around the corner? 2026? It's tempting to look for villains. To blame the greedy bankers, the sleeping regulators, the foolish speculators. And they all play their part. But the true architect of this repeating pattern is more intimate. It's us. It's the wiring in our own brains. The dance between greed and fear is the oldest story of all. We are pattern-seeking animals, but we are also masters of self-deception. We crave the story of easy wealth. We are terrified of being left behind. This fear of missing out is a more powerful market force than any interest rate. The system we've built is a perfect reflection of our own nature. It privatizes profits and socializes losses. It rewards recklessness in the boom times and punishes the prudent when the bust arrives. We study history, we write new regulations, we promise to never let it happen again. But we are fighting against ourselves. We are fighting the siren song of the rising number on the screen. Perhaps these crashes are not a flaw in the system. Perhaps they are the system, a brutal periodic cleansing that washes away the excesses of human optimism, a painful reminder that there is no reward without risk, no growth without gravity. We stand today on what feels like a familiar precipice. The air is thin, the view is intoxicating. And below us, the fog of the future conceals a familiar shape. We can't predict the exact day or the exact hour, but we can recognize the weather. We can see the storm clouds gathering on the horizon. The final question isn't whether we can stop the next crash. It's whether we can survive it. And whether, after the flood, we will finally learn to build on higher ground. Or if we are destined to simply rebuild the same beautiful, fragile house of cards all over again, waiting for the wind to change.